Pankaj Tibrewal, Senior VP and Fund Manager Equity at Kotak Mutual Fund, joins in on the show right now. Pankaj, have to start with Reliance and Unilever's earnings. What did you make of them? Beat as they may be, it doesn't seem like the valuations could pull the stocks any further up.
Good morning. I think from an earnings perspective, after a long time, if you look at corporate India earnings, it's been stuck about 4 to 4.5 lakh crore, the entire corporate India. Our expectation is that FY 19-20 will be the first year where this range would be, we will see a breakout of this range. And that's basically because over the last 3-4 years, if you look at, the corporate sector lenders were a big drag and a couple of global OEMs. Our expectation is that next year, the normalization of profits would take place in these. There'll be lower provisioning, and hence you would see a normalization of profits in these 3 or 4 corporate sector lenders, and hence the entire profit, which is stuck between 4.5 lakh crore, should move to 5.5-6 lakh crores. So having said that, Q3 we don't expect any fireworks in earnings, basically because if you look at last quarter, till most part of the quarter you had higher raw material, and really towards the first week of December you saw a very sharp fall in most of the commodity, and that would weigh on inventory losses across most of the companies. So yes, the season has started on a mixed note. We saw some good numbers by large cap IT companies, and yesterday obviously the oil and gas major and the FMCG cheered the markets, and most of them were in line with expectation, but it's just the start of the earnings season. Let's see how it progresses towards in the next 15-20 days.
What is your expectation in terms of the returns the markets can generate, mapping them to earnings?
So our expectation is that FY 20, which is just 2-3 months away, the earnings growth should be about 18 to 20%. We are lower than the street, and street is somewhere about 25-26%. We see some risk to that estimate. We believe 18 to 20% is more likely, and that's basically happening because of, as I said before, the 4-5 companies which have been a drag on earnings for the last almost 3 years on Nifty probably start normalizing its profit, and that's actually giving a kind of upsurge to the earnings growth in FY 20.
What are you expecting from the upcoming budget?
So clearly this budget would not be a full-fledged budget, as the government has already presented 5 budgets. It's more likely to be a vote on account or interim. The expectation around the street is more towards something to do with farm. A lot of talks on the street on universal basic income, something to do on the lines of Rai Bantu scheme of Telangana, to give something to the farmers. So clearly one thing is for sure, that the commentary which is coming out of the government and different experts suggests that something will be done to support the farmers, because of the excess agriculture produce in the country, they are not able to get the realization, and that's the part of the economy which continues to be under pain. And obviously government moving into election would like to support that constituency or that part of the economy. So we could see some measures to support the farmers. On the other sides, there could be some exemption or increase in the tax slabs which markets are talking about. Apart from that, we don't expect anything major or big bang reform to take place in this budget on 1st of Feb.
Okay. Do you think the upcoming election towards the mid part of the year would be a bigger trigger for sure? And you know, typically, historically, if you do track the market performance in an election year, there's rarely been a time when the market has gone negative. Would you believe that it would also just come and go, and at max it'll be a 2-day event, or do you think it would really materially change the course and direction of the markets from that event?
So obviously elections always play a role. If you look at for the last 4-5 elections. In the short term, it plays a very important role because sentiments are linked to that. But over a medium to long term, I think it's more the direction of the government in terms of policy reforms which takes over. And our belief is that if we get a stable government, markets would cheer it. But till the run up to the elections, markets are likely to be volatile. You are seeing consolidation in the market. But the good part is that we have started 2019 on a better note. Macros are looking much better. There's expectation, as we discussed, earnings growth is looking much better for FY20. So I think both the things together will make sure that the market doesn't have too much of downside. And if we get a stable government in May, I think markets will find its own direction.
And if we do get a stable government in May, by the way, how would you qualify a stable government? Would it mean an absolute majority? Would it mean a slim majority? Or a dominant BJP comeback with allies, which is, I'm talking about a seat number of 220 plus allies?
I'm not a political expert, but looking at the equations, what it's being talked about, I think somewhere around 200, 220 for BJP on a standalone basis should be good enough to stitch a government along with few of the allies. And I think market's expectation is somewhere around that. So I think we want a government where there is a clear leadership, even if we don't mind if there are few allies which join the government and give a direction in forms of reforms. I think that's something which market is expecting. But as I said, I'm not a political expert, and it's still 3-4 months down the line. Anything can change in politics overnight.
Yeah, indeed. So Pankaj, considering it's going to be a very edgy and unpredictable time in terms of political events, what do you think should be the right tactical approach? Because, we were chatting with a lot of experts and they believe that maybe 5 to 10% allocation in one's portfolio could also be done to gold ETFs. Would you say diversification right now is key?
So yes, in the near term, always we have been advocating asset allocation. But if you look at over the 5, 10, 15, 20, till December 31st, 2018, equities has emerged to be the best asset class to be invested in. Last year, in fact, gold for the first time after a long time was one of the best asset classes. And if you look gold in terms of Canadian dollar and Aussie dollars, it's almost reaching its all-time peak, because both the currencies have depreciated against dollar. So yes, a little bit of weight, maybe 4-5% to gold is not something which we are not asking for. But on a longer term basis, equities is the asset class to be in. And if you look at what we are advocating today, is that the divergence of performance between Nifty and mid and small cap is at historical extreme. History suggests that such divergences don't exist for too long, and the following 12 to 18 months, mid and small caps tend to outperform. So on a headline basis, if you look at the valuation at 17 and a half time 1 year forward, Nifty doesn't appears to be cheap. But if you look at the broader market, we are started to see bottom-up stock picking opportunities, and we are advocating to our clients that increase your mid and small cap allocation gradually over the next 6 to 12 months, because opportunities would emerge. And because of the election uncertainty, there will be volatility, and there will be an opportunity to buy good quality companies at reasonable prices.
Okay, Pankaj, we leave it at that. Thanks very much for joining us with your thoughts on the market.
Thank you so much.